Thank you for inviting us, Chris. It's a pleasure to be here with you all. I'm just going to share my slides. Great. Can you see that okay? Yeah, great. Okay, cool. Okay, so I'm beaming in today from Songye's territory. I really appreciate the territorial acknowledgement that you started out with, Chris. So I'm going to tell you the story behind recent corporate mapping research on the Canada Pension Plan and climate risk that I've been engaged with Jessica Dempsey and Zoe Juncker. We've sort of been a core that's been doing research on pension funds in Canada, and a number of wonderful research assistants have joined us along the way. And for this particular project, Katie Reeder and Jack Vincent brought their considerable skill to the project. So we've been focusing our recent corporate mapping research on pension capital since the world's largest pension funds comprise over half of global investment capital. Canada's pension plans are collectively worth approximately $2 trillion. And so how pension funds choose to invest has significant bearing on how we collectively address the climate emergency and the needed energy transition away from fossil fuels. Another benefit of focusing on pension capital, especially a national fund like the CPP, is that it can help make the rarefied and often abstracted world of finance capital more concrete. The CPP invests the retirement monies of 20 million Canadians, so basically any citizen outside of Quebec who has done waged work in this country has paid into it. In Quebec, over 4 million people contribute to the CDPQ, which is worth approximately $400 billion. And while this presentation is focused primarily on the CPP, I will discuss La Caisse momentarily. So between contributions to CDPQ and CPP, a majority of Canadian adults are ostensibly owners of publicly traded corporations that are regularly up to no good. And so, for example, during the nationwide Shutdown Canada protests in solidarity with Wet'suwet'en land defenders, the CPP had $200 million invested in TC Energy, the company pursuing the Coastal GasLink pipeline. And so the CPP's relationship with multiple firms can help to clarify our direct material stake in issues from Indigenous sovereignty, gun violence, militarism, and climate change, which is our focus today. This also demonstrates the complicated ways that our very social reproduction, in this case our ability to buy food, pay rent upon retirement, is intimately tied up within a financial system that is legally bound to seek the highest return for beneficiaries. So in August of last year, we released this report with the Canadian Centre for Policy Alternatives, An Insecure Future. Canada's biggest pension plans are still banking on fossil fuels. So I'm going to dig into this research now. Our major finding is that since Canada signed the Paris Agreement in 2016, the CPP, which is Canada's largest fund worth over $500 billion, has actually increased their investments in fossil fuel companies. And this despite multiple claims by the CPP to be a climate-aware investor. And this is just some of many different examples of wordage pulled off of the CPP's website. So in our research, we focus primarily on public equities or investments in companies that sell shares on the stock market. And we found that the number of shares in oil and gas held by the CPP by the end of 2020 was 7.7% higher than the number of shares it held at the beginning of 2016. And so this is a graph with our findings. You'll see here, it's actually, we have plus 6.8%, which is the average annual change, which factors in all the intervening years. But for simplicity's sake, if we just look at the number of shares they held in 2016, and then we look at the number of shares they held in 2020, it's a 7.7% increase. And so we focused on the number of shares versus other possible metrics because we thought that that would give us the clearest picture of a directional trend over time. And to be very clear, this metric of number of shares is not typically used in finance to model a fund's engagement with any given sector, such as fossil fuels. Usually funds like the CPP emphasize the percentage a sector constitutes of the total assets under management. And so while that is an important metric for individual funds, a decline in the ratio of fossil fuel investments compared to other sectors does not necessarily mean a decline in total fossil fuel investment. It could simply mean that the overall fund has grown, thus sort of drowning out that sectoral investment. And so this level of detail might seem particularly pointy-headed of me, but it's actually of real significant practical consequence. And I wanted to share a couple of stories to clarify why we made the choices we did in terms of focusing on number of shares in our analysis of the CPP and CDPQ's public equity investments. And so first story is that 3 months after our report came out, the Smart Prosperity Institute and other organizations released a report that contained findings that seemed to contradict ours. So this report came out in November. They showed that the CPP's sectoral exposure to energy companies had decreased considerably since 2011. So I'll just show you, this is obviously a bit of a messy graph, but just to simplify things, you'll see that energy is in blue here. And if we look at their sectoral exposure to energy in 2011, it's up over 10%. And we move down to 2020, and it's clearly reduced considerably. And so writing about the report, the editor of Corporate Knights noted how the Canada Pension Plan slashed the value of their fossil fuel holdings by more than 90% over the past 10 years, from more than 13% of total equity investments to less than 3% in 2021. And so here we have two competing data points that tell quite different stories. We have the data provided by the Smart Prosperity Institute that applauds the fund for their seemingly reduced exposure to fossil fuels, but then you have our data that's actually challenging the fund for its sluggishness, pointing to increased share purchasing of fossil fuel companies. And so what's going on here? So a key point to note is that sustainable prosperity's metric does not account for the fact that the Canadian pension plan has grown from approximately $148 billion in 2011 to over $500 billion in 2021. And so here you see the growth curve of the fund. So, again, around 150 million or billion, I should say, in 2011, and then up over 500 billion in 2021. So that's a really big shift in fund size. And so the reason that their sectoral exposure to energy companies has decreased is because the fund has grown in leaps and bounds, while their fossil fuel investments have only grown relatively modestly compared to the overall growth of their fund. So, contrary to Smart Prosperity and Corporate Knights' framing, the fund's material support for the industry has grown, not shrunk. But again, depending on what data point you use, it could actually look like the reverse. But again, the data that we chose, which we think is accurate for reasons that I'll continue to flesh out, it again shows that the material support that the fund is providing to fossil fuel companies has grown, not dropped, since Canada signed the Paris Agreement. Another metric commonly used to describe fund composition is the market value of a fund's investment in a given sector measured in dollars. But that metric can also be unreliable. And so just in simple terms, like we were looking at number of shares, you might be asking, why aren't you just looking at the amount that they hold monetarily in fossil fuel companies? And so that can also be unreliable, and that drops in total market value of public equity investments could be the result of reduced shareholdings, meaning that they're moving out of the sector. But it could also indicate drops in share price in the wake of a drop in the price of oil, for example. And so to avoid these limitations, we focused on changes in the number of shares invested in oil and gas each year. And I think, again, another story will help clarify why the data point we chose matters. And so the CBC, Canadian Broadcasting Corporation, reached out to us in April because they were planning to do an episode of their national climate change show, What on Earth, on climate finance. And they wanted to include our research on the CPP, even though it hadn't been published yet. And so we shared our preliminary data with them. and we're preparing to do an interview. Prior to the interview, we received a nervous phone call from the program's host, Laura Lynch. The CBC had shared our data with the Canada Pension Plan to receive comment for them for the broader story. And the Canadian Pension Plan responded by saying to the CBC that we were spreading misinformation. And they also shared their own internal data, which they claimed contradicted our findings. And so one of their executives wrote, and it was one of their executives that responded, not just a sort of lower down PR person. And so they took the challenge seriously, but they say the attached shows the facts. 11.6 billion is not bigger than 15 billion. And so this is in reference to the fact that, we've got their holdings, and this is their total holdings across all asset classes. And so the executive is pointing to how you look at, they have 14.9 billion held in 2018 and it's down to 11.6 in 2020. And so that would show a decrease. And so, what are we on about? And so Lynch from the CBC wanted to know, like, okay, we're about to interview you folks and we're wanting to broadcast your research, but is it bogus? The fund seems to be pointing us in a different direction. And we're providing data, us and then the CPP are providing data with opposing implications. But again, recall our earlier point that a drop in market value does not necessarily mean reduced investments. It could simply mean that the fund has just lost money. The oil and gas sector was the worst performing sector on the stock market in 2019 and 2020, respectively. But even more important to us, the data that the CPP shared with the CBC, sorry for the acronym soup, the data just confirmed our findings, but in different terms, in that the fund held, if we look down to 2015, the fund held $8.5 billion in fossil fuels before Canada signed the Paris Agreement, and it held 11.6 billion in 2020. So that's an increase of over 25% in just simple dollar terms. When you triangulate that finding with the overall increase in shares purchased, then you get an even fuller picture of how the CPP has not reduced its investments in fossil fuel companies since the Paris Agreement. It has increased them, and by multiple metrics, even though there, of course, is some oscillation year by year. But again, if we just look at terms of the question we pose of pre-Paris Agreement and post, there has undoubtedly been an increase in both shares purchased and overall monetary value of investments across all asset classes in fossil fuel companies. The data does show, for those of you who have maybe continued to read along this table, this data that the CPP provides does show that they have grown their renewable energy investments considerably. So up from 30 million in 2016 all the way up to 6.6 billion in 2020. And that's a generally good thing, although some of these renewable investments have their own challenges associated with them. But this is generally a good thing that we applaud in our report. But in the same way that eating an anti-cancer diet while smoking more cigarettes is not a wise way to reduce health risks, increasing fossil fuel investments is a dangerous mitigation strategy, even if you are investing more in renewables. And so we think that the real litmus test for investors for climate impact the real litmus test for investors is looking at the climate impact of their most polluting investments. And the CPP has increased their material support for fossil fuel companies during this critical action window, which for us means that they are failing the climate action or climate energy transition test. Now, until the CPP shared this data with the CBC, we actually had no way of knowing how much the fund's total investments in fossil fuel companies had fluctuated since 2015. From what we've seen, this data that the CPP shared with the national broadcaster is not publicly available. And so accessing and interpreting data when doing financial research can be very challenging. Because of limited data, we had chosen to focus on public equities in our pension research because the data is more publicly accessible. This said, we had to use Bloomberg Terminal, a powerful investment tool behind a significant paywall, to generate historical data on pension fund equity investments. For funds that do publish their holdings online, which is a minority of them, that only represents a snapshot in time. And the value of Bloomberg is that it offered us a more granular historical data on the CPP's fossil fuel investments over time. We started out this research planning to compare Canada's largest pension funds across time, but quickly found that even when using an expensive tool like Bloomberg, accessing serviceable data was very challenging. And indeed, one of our core findings in our report was that besides the CPP and CDPQ, Canada's pension funds are really bad at reporting their investments. And so as this table shows, there was only a 6% discrepancy for the CPP in terms of what they said they held in public equities and then what was reported to the SEC and then showing up on Bloomberg. 0% difference for CDPQ, which is why we could actually look at these funds in our report, which is what we did. But we had no serviceable data for AIMCO in Alberta or BCI in BC or Ontario's teachers in Ontario, because there's just a massive discrepancy between what they said they held in public equities and what they were actually reporting to the SEC and then showing up on the Bloomberg terminal. So as the story from the Financial Post notes, one of Canada's largest pension funds, they're referencing BCI here in British Columbia, forgot to disclose $2.5 billion in Canadian holdings, and it's not the first time. So Bloomberg pulls a good chunk of its data from US Securities and Exchange Commission submissions, and Canadian pension funds are really bad at making those submissions, which makes for sometimes subpar data, even on a powerful tool like Bloomberg. The fact that we even had to use an expensive tool like Bloomberg to do an historical analysis of the CPP's fossil fuel investments points to profound limits in data transparency and disclosure. And that's why one of our recommendations in our report was for the federal and provincial governments to mandate Canadian pension funds to disclose the names and dollar amounts of all holdings across all asset classes, not just public equity, but private equity as well. And where possible, total the emissions of investments in the fossil fuel sectors so that beneficiaries, researchers, and citizens can know the impact of their investments in fossil fuels and high carbon industries. So far I've focused on our CPP findings, but our report did cover the holdings of Canada's second largest public pension plan, the CDPQ in Quebec. And using Bloomberg, we found that the CDPQ did actually show a decrease in the number of shares held in oil and gas companies since Canada signed the Paris Agreement. And so these are our findings for CDPQ. And so again, there's an average annual change of minus 3% from 2016 to 2020. Again, for simplicity's sake, if you just look at the number of shares held in 2016 and then the number of shares held in 2020, it's actually a minus 14% differential, which does show, again, a declining trend in investment. So we sort of applauded that declining trend, but noted that it was still too slow of a directional move given the pressing challenge that we face. This said, a month after our report came out, the CDPQ made a major announcement pledging to divest from all oil-producing companies by next year. They will maintain investments in natural gas and pipeline companies, but this does remain, so it's not a perfect announcement, but this remains the biggest shift Canadian pension capital has made on the climate risk front to date. So it is a big deal, a big announcement. The CDPQ has now joined the ranks of other major funds, pension funds, pursuing a divestment strategy. The United Kingdom's largest pension fund has, Europe's largest fund, BP in the Netherlands, and New York State pension fund are some of the recent funds that have made a divestment announcement. A question that's begged for us is, why is the CPP such a laggard? And that not only have they not made any divestment announcements, but they've actually increased their material support for fossil fuel companies in this critical action window. So why is that? It's noteworthy that regions such as New York, the United Kingdom, the Netherlands, and Quebec are not major fossil fuel producers. English-speaking Canada, on the other hand, is the world's fourth largest petroleum producer. as Bill already outlined, the Canadian fossil fuel sector's economic power helps explain why the industry has a tentacle-like reach into all aspects of Canadian society, including national pension oversight. Excuse me. As part of our research, we examined the composition of CPP's governing board for ties with the fossil fuel industry and its primary financiers using the little sis tool that Bill mentioned in his research, in his presentation. And so of the 12 members on CPP's board of directors, 6 have either worked directly for or served on the boards of fossil fuel companies and their financiers. The CPP lacks a single board member with climate risk related expertise. And that's embarrassing for an institution whose primary mission is planning for the future. We also did an analysis of CDPQ's board. And while we didn't publish that finding, we found that they had minimal connection to the oil and gas industry, which makes sense because Quebec is not a major producer, and that lack of industry influence likely also explains their divestment decision, whereas CPP has gone in the opposite direction. When recently asked about industry influence over investment decisions, the CPP responded by calling it unfathomable that the fossil fuel sector would yield disproportionate influence. And yet, in the midst of a climate emergency, the CPP has been increasing its investments in fossil fuel companies while other funds pursue divestment strategies. So we think that climate risk audits at CPP and other institutional investors will be wise to include the risks associated with having representatives from the fossil fuel industry and its financiers sitting around decision-making tables. So I want to conclude by speaking to the difficult politics of changing the trajectory of the CPP. First, some of the good news. All 3 center-left parties in English-speaking Canada pledged CPP reform during the last election. In their recent election platform, the Liberals promised to develop, quote, net zero plans for federally regulated institutions, which includes financial institutions, pension funds, and government agencies. The NDP and Greens, who also included CPP reform in their platforms, will of course need to push the Liberals to genuinely enact this pledge, given the lobbying money being spent by the oil and gas industry to gum up the gears of transition. NGOs like Some of Us and Shift Action for Pension, Wealth and Planet Health, who have been affiliated with corporate mapping research, are working to build popular support for these needed political changes in their engagements with civil society. Some of Us is sort of just runs these massive petition campaigns. Shift Action does more sort of organizing of beneficiaries. And this is all really important shorter term work. And yet the existential threat posed by climate change is enough reason to rethink many of our collective institutions, including pensions. And so, we think that Green New Deal or just transition visioning in Canada should consider the possibility of even bolder reforms, sort of beyond divestment, like a definancialized and truly universal pension program that supplies dignified retirements for all. So that is obviously a longer term horizon or project. In conclusion, the CPP was designed to promote retirement security, and yet by increasing fossil fuel investments during a climate emergency, it is making all of us less secure. The CPP and its overseers in government need to start taking our futures seriously, which is the whole point of a pension fund in the first place. So I'll leave it there and turn off my slides so that I can see if there are any questions.